The stock market is looking fairly strong today for a lot of companies that weren't shown a lot of love just over the last few months. And in today's episode, we are going to take a look at a report from Morningstar that talk about 33 undervalued stocks, and these are their top picks for quarter 3 of 2024 that they do believe to be undervalued and very strong buys. Now today we're going to focus our analysis on 5. They do look very strong in terms of margin of safety, in terms of yield, as well as in terms of the long run share price return. So the first one we're looking at is the Kraft Heinz company. Now we can see it is trading in the mid to lower end of the 52-week range. It is down around 8% over the last 12 months, and if you've been a shareholder over the last 10 years, well, you would be down around 44%, but as always, remember past performance is not an indicator of future performance, and we do note a double buy rating seeking alpha in Wall Street, although we do see a hold from Quant. One thing we do quite like is that the forward yield is sitting near that 5% level. As the interest rates do start to get cut, these will look a lot more attractive, and hence we do anticipate the share price will increase. And we can also see the forward P sits at 10.69. Now in terms of the dividend safety, it does sit at 60, so we will take a look at that. And we also want to point out, even though the forward yield is very nice, they haven't increased that dividend since 2019. Now, it wasn't too long ago, in fact, May 15th, where it was reassessed, and they do believe that the borderline safe score is reasonable, meaning for Kraft Heinz, there is a moderate risk of a dividend cut over a full economic cycle. Now, in terms of the last recession, they essentially had negative 5% recession sales, which was marginally higher than the S&P, which did sit at negative 12. Now, not something we do quite like to note, they haven't increased that dividend since 2019, negative 9% due to a cut over the last 5 years, and over the last 20 years, again, it hasn't moved, it is sitting at that 0%. No surprises then that we do see 0 consecutive years, but they have been paying a dividend for the last 4 years without a reduction. Now, in terms of dividend yield theory, what we do note is a double undervaluation signal, both on the yield as well as the forward P. Essentially, what this shows is that a company is undervalued when the current yield sits above the 5-year average, and we also note, given the forward P is much lower than the forward 5-year rate, we do note that double undervaluation, in fact a triple undervaluation today, as the consumer staples sector does sit significantly higher. Always bear in mind though, we're not looking at any one of these models in isolation, and we will shortly conclude for this company. In terms of the free cash flow payout, that is what we draw your attention to. A lot better than the earnings, which, as we do mention from time to time, is susceptible to manipulation by management through accounting. Now, 2022 was very high, 126%, essentially indicating management paid out more in dividends than they generated in free cash flow. Not something you would have noticed by looking at the earnings. Nice to note though, in 2023 it is around 66%, which is lower than the 70 for the industry. Next 12 months coming down again to 51, so hopefully we can see a nice, or at least an in line with inflation increase to that dividend around 4%. In terms of free cash flow, something that we want to see is consistent increases over longer term. It is fairly inconsistent, we do have to say, although from the lows of 2022 it has increased in 23 and is expected to continue that upward trend over the next 12 months. So maybe this could be a value play, something that is going to turn out to be a very good investment over the next 10, even though, as we saw historically over the last 10 years, it wasn't a good investment. In terms of sales growth, well, 3 to 7% when we do our deep dives, and the overall conclusion to note here is that they have found it very difficult over the last 10 years, or in fact the last 7 to be exact, to increase their prices in line with inflation at around 3 to 4%. So do bear that in mind as well. It isn't a fast growing tech company to anticipate large increases year on year. And as we can clearly see numerically speaking as well, pretty much from 2016, they have found it incredibly difficult to increase their top line. In terms of shares outstanding, well, what we do know is, yes, they've diluted your position over the longer term, but if you did buy from 2016 onwards, it hasn't really moved. Very trivial to say the least. Then we look at the ROIC. Now, for consumer staples above 12%, give us that faith that management are able to effectively allocate their capital. We don't get that above 12%, or in fact the above 10% I like to look at, but it is very consistently around the 7 to 6%. We then move on to the margins. Now, nice to note that it is above the minimum 16% every single year. The only thing, again, that we would like to see, not only an increase in the top line revenue over the next few years and beyond, but also increasing margins as well. that would really help with this business. And in terms of the free cash flow margin, nice to report that over the last few years it has been fairly decent, but again, bear in mind we have noticed some inconsistency with KHC, something to conclude when we do look at the margin of safety. We then draw attention to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, below 4, and why we love this metric, it correlates to dividend safety, balance sheet strength, and the numbers you see, remember the number of years it would take the company to pay off all of their debt net of cash on hand. 2.7 in 2023, 2.59 over the next 12 months, so no real worries with this company. Yes, the free cash flow payout does fluctuate, maybe something to keep an eye on, but overall it doesn't look too bad. Now the important thing to understand is if this is a company you do want to buy, to get it at the right value with the right margin of safety. Now our intrinsic value of $38 comes from these 4 models, which when we do our deep dives, we do run through every single one of these. The inputs and the outputs are discussed. What we also know, Wall Street do consider this to have 20% upside, price target of $39.31. Bear in mind as well, you are essentially getting a forward yield that is just under 5%, which I believe will look incredibly attractive next year this time when we do look back. In terms of the margin of safety, well, 10% as always is what we start off. We execute on that if it has a wide moat, strong financial metrics, good forward-looking data. Look, if you believe that, well, buy up to $34.20, and then we keep going till it's near the current trading price. Today's episode not too dissimilar to a 15% MOS level, so with that you are getting 20% upside according to Wall Street. As always though, let us know your thoughts, whether or not you do believe that even though there are some inconsistent metrics, that you are happy given the high yield, which I said will look attractive in the not too distant future. Before we move on to the next stock, just to let you know, we have released our latest free weekly article. If you want access to this or any others, it is all completely free. You can click on the pinned comment below and you will get instant access. And also just to let you know, the previous article that we did release last week does include a free spreadsheet as well, so do get that while you can. The next stock that we're looking at is Schlumberger Limited SLB, with a strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. Again, similar to KHC, trading towards the lower end of the 52-week range. Not as nice in terms of yield, but still 2.29% is fairly attractive. Forward P just below 14, and when we do look over the last 12 months, down 14%, over the last 10 years again, down 56%. So the main question to consider is, do you believe that they will be able to turn their performances around? Something that again you can consider when looking at the MOS level. Dividend safety score, well, 60, borderline safe, with a nice double-digit increase to the dividend in January. And for those that don't know, in terms of the sector, it is the oil and gas, equipment and services. In terms of the score, well, again, it was reaffirmed what that 60 score means, which is the same as what we just ran through for KHC. Now, last recession, 07-09, the Great Recession, in fact, they maintained the dividend, didn't increase it, didn't cut it. They had below average growth at negative 17%, and they also marginally trailed the S&P with their negative 64, as we can see the S&P itself negative 55. In terms of dividend growth, well, double digit just this year, negative over the last 13 years, 5% over the last 20. So again, we do in fact see that this did have a dividend cut not too long ago, and therefore we can see 2 years of consecutive increases. We then move on to dividend yield theory, where we do get that double undervaluation signal both on the yield and the forward P, when we do take a look pretty much in line with the energy sector there, sitting at 13. Now, in terms of looking at the payout ratio, well, below 40% is the target for the industry oil equipment providers. It has been very, very inconsistent. Just nice to know, over the last few years, it has come under control. 36% again anticipated over the next 12 months. Hence why, in fact, we did see that nice double-digit increase just this year. Again, with this industry, very cyclical, so we will see a lot of peaks and troughs across the board over a 10-year period. Again, so this is something just to consider. And I'm not surprised here when we do come to look at the sales growth that 4 of the last 10 years have been negative. Last 2 years, though, looking very strong double-digit growth. And as always, with cyclical industries, whether it's in the oil and gas industry or any other industry, you want to be buying it when it is out of favor, when the share price is very low and all the metrics are showing it is towards the bottom of the cycle. In terms of total sales then, we can see that numerically from the percentage we just saw above, and no surprise as well, they have diluted your position, although very marginally over the longer term. When we look at the ROIC, well, nice to note, above 10% over the last 2 years, and in fact from the lows of the COVID 5%, it has been increasing, and a 17% on a trailing 12-month basis does also look very good. And when we look at both operating margin and free cash flow margin, very inconsistent. On the operating side, it doesn't consistently get above 15%, but nonetheless, the last 2 years are looking positive. On the free cash flow, every single year, at least the minimum 5%. More recent year, 12% does look good. Net debt to EBITDA, very important, especially for a company that is cyclical. Below 2.5 is exactly what it is as well. 0.93 in 23, 0.8 over the next 12 months. So it does have a very strong balance sheet. Yes, the free cash flow does fluctuate a lot, is fairly high. But what you can say, the balance sheet does look very strong for the future. In terms of evaluation, that will always be important. One of the reasons we had it on our radar, we can see Wall Street very bullish on this company, 37% upside, and we also saw that when we looked at the ratings, it was given a strong buy. Our intrinsic value though, marginally lower at $58, and when we do use our margin of safety, a buy at that 10% level at $52, at 15% around $49, which is pretty much where it's sitting at in today's value. So as always with any of these stocks, do let us know your thoughts below if you want us to do a deeper dive, but we can see SLB, we see around 15% margin of safety, and Wall Street very bullish, strong buy, an upside of 37%. We then move into the semiconductor space with STMicroelectronics with a double buy and a hold from Quant, pretty strong buys as well from the two analysts. Again, the trend following that as well towards the lower end of the 52-week range. The yield very similar for these in the industry in the semiconductor space. They're not going to be the largest at 0.85%. Forward P around 19.5. S&P, whilst we haven't mentioned it, is currently around the 23 mark. Over the last 12 months, well, down 20%. Over the last 10 years, significantly outperformed the S&P, up nearly 400%. Now, it doesn't currently have a dividend safety score, but what we do know, just over the last full year, they did increase that dividend by a strong 50%. In terms of dividend growth, well, 8% over the last 5 years, and we get to see a nice 6% over the last 20. At least at a bare minimum, it is above that inflationary rate if you have been holding it for that long. We then move on to the metrics. Free cash flow payout, it has been decreasing over the longer term, which is no surprise while we are seeing those very strong dividend increases. At 11% over the next 12 months, we wouldn't be surprised to see a very strong double-digit increase to continue the theme for STM. In terms of free cash flow per share, well, this is exactly what you want to see. Consistent large increases over the longer term. And we do know it has pretty much 10 times since 2014. And over the next 12 months, it is anticipated to continue the upward trend. Sales growth, again, very strong over the more recent period. Last 4 years looking very, very healthy. And we can see, in fact, more than doubled from 2014, 7.4 billion to 17 billion in the more recent period. In terms of shares outstanding, again, marginal increase, so marginal issuances, nothing really to discuss on that topic. We then look at the ROIC since 2017, above the 10% we want to see and increasing. Nice to see a 23% in 2023. Again, this will make it very attractive to potential investors or those who are looking to add to their position. On top of that, for the margin, we see operating efficiency going from 3% in 2014 to 27% in 2023. Same to be said for the free cash flow, strong in 2015, and since then it has been increasing 10% over the last 2 years, as well as on a trailing 12-month basis. And finally, when we get to the net debt to EBITDA, essentially showing us over the last 4 years and anticipated over the next year, not even 1 day for them to pay off all of their debt, net of cash on hand, a phenomenal balance sheet. Now, our intrinsic value comes to around $57, which is significantly higher than Wall Street, who do see upside at around 21%. With our margin of safety at 10%, well, we see a buy around $52, at 15% around $49, and in today's episode, it even has more than a 20% MOS level, sitting right there at the 25% mark, with upside of 21%. Definitely one we would say to consider for the portfolio. As always though, do let us know your thoughts. You may already be very overweight in this sector. We then move on to Humana Inc. Now, we haven't covered this since it dropped all the way to its 52-week lows, but we do get a buy rating from Wall Street with a double hold from the other analysts, currently sitting still in the mid to lower end of the 52-week range. Yield 0.92%, forward P 23.5, and when we do look at the performance over the last 12 months, down 8%. Over the last 10 years though, you would have outperformed the S&P, plus 208%, and we can see all-time highs October 2022 at $552. Nice to note, a very safe dividend score at 99, although we are still waiting on their latest dividend increase. And when we take a look, reaffirmed, essentially what this score means, it is very unlikely that they will cut that dividend. And we also note, whilst they had above average growth during the Great Recession, they did significantly trail the S&P, negative 72%. Now, one of the things that they're historically known for are those double-digit increases to their dividend, 13% in fact, over the last 10 years. So hopefully we see something soon very similar. And they have also been increasing those dividends for the last 12 years. Now, in terms of dividend yield theory, no surprises, undervaluation on dividend yield. However, when we do look at the forward PE, it does sit higher, 22.9 versus 19's 5-year rolling average, as well as being higher than the healthcare sector as a whole. Now, when we look at the free cash flow payout, in fact, 2023 at 15%, 2024 anticipated at 18% is significantly lower. In fact, every year below 60%, so that does look very healthy. And in terms of the free cash flow, very inconsistent, but over the longer term, you are seeing more than 3 times growth, although we are anticipating a drop into 2024. In terms of sales, well, we get much better than the 3 to 7% over the longer term. In fact, 15% in 2023, 14% on a trailing 12-month basis is very, very nice to know. And in fact, they've more than doubled their top line just over the last 10 years. And this is the first one today where they also do some very nice share buybacks, reducing essentially the shares outstanding over the period, effectively returning excess cash to your pockets as you do essentially end up owning a larger chunk of the company. ROIC again consistently above the 10%, and even though we do see an inconsistency on a year-on-year basis, over the longer term, it does look very good. In terms of operating margin, something that we do believe we would like to see higher, but a lot of the companies in this sector, as you will have seen if you've watched our episodes, are very, very similar. They are lower than what we tend to like. And in terms of the free cash flow margin, same story to be told there. Net debt to EBITDA, though, fantastic over the last 10 years and over the next year anticipated, not one day to pay off all of their debt net of cash on hand. Now, Wall Street do see around 16% upside. Their price target of $460 isn't dissimilar from our 456 intrinsic value. And when we look at the margin of safety, 10% a buy at 410, 15% not that far off, so near a 15% MOS level for this company. But as we mentioned, it was a very strong buy when we did come to analyze this, when it did drop right the way down to its 52-week low. As always, though, do let us know your thoughts, whether like Morningstar you are very bullish on this healthcare company. Again, one that we haven't covered in some time, Nutrien Limited, with a double buy and a hold from Quant. Again, trading right there towards its 52-week lows with a yield of 4.32%, forward PE below 13, and over the last 12 months, not the greatest performance, negative 16%. Over the last 5 years, it is pretty much flat, and we do see all-time highs. April 2022, $115. That is more than double the current trading price. Now, when we talk about dividend safety, we do have a borderline safe score, so let's take a look and understand that. Dividend growth, 1.9% this year. As always, that is very, very trivial. We want to see at least with inflation. And what this means, and it was reaffirmed at the end of May, that there is a moderate risk of a dividend cut over a full economic cycle. We also note, if you do believe a recession is inbound, well, last recession, they had negative 59% sales during that period. Dividend growth, well, over the last 5 years, at least above inflation. Over the last 20 years, 20%, so very large increases, something that we would like to see them go back on in the not too distant future. In terms of increases, though, 6 years of consecutive increases. And when we do take a look at dividend yield theory, we get an undervaluation signal on the yield, although we do note it is pretty much in line with the 5-year average, but significantly lower than the materials sector at 19.9. Now, when we focus on the free cash flow payout, we do like to target below 40% for chemical producers, and it isn't too bad when we do look at it over the more recent period. In fact, below 60%, as I've already mentioned, is sufficient for me personally. 44 in 2023, 48 over the next 12 months, so no massive red flags so far. When we look at the free cash flow per share, we do see massive growth in 2022, and even though it has dropped in 2023, that is still a large increase from the position that we saw in 2014. Something to point out, though, over the next 12 months, it is anticipated to marginally drop. In terms of sales growth, well, very, very inconsistent. Again, you could argue cyclicality. Some very strong years, some very good years, and also we've seen the more recent, some very bad years. So overall, not looking the greatest for those that do want to see consistency, but for those that do see a lot of value like Morningstar, then it could be one to consider. In terms of numericals, though, they have pretty much increased their top line by more than 4 times over the period, and they've also nearly halved their shares outstanding over the last 10 years, so you could argue there is some value to consider for NTR. In terms of ROIC, though, you're not going to get that consistency that we do like to see. Over the last 3 years, though, it does look nice. Bear in mind, on a trailing 12-month basis, it has dropped to around 7%. In terms of operating margin and free cash flow margin, a lot of inconsistencies right across the board. Not the worst, to be fair. Above 15% is what we want to see, and near enough there every single year. In terms of the free cash flow margin, pretty much above 5% every year. But again, it will come down to what you're looking for as an investor. And as always, the most important thing is that valuation. Below 2.5 for the chemical producers net debt to EBITDA, 2.02 in 2023, expected to go a little bit higher in 2024, so something just to consider there. So we do understand why we do have that borderline safe score in the dividend, but the free cash flow payout over the last few years doesn't look too bad. Based on the information, the dividend does look okay for the time being. Now that is just based on the information we have. Looking at the intrinsic value, well, first thing to note, again, Wall Street are very bullish. They're upside 32%, so we can understand why Morningstar did say as this one of those to consider for quarter 3. When we look at our intrinsic value, we also see it heavily discounted with a current price of $51. That means an MOS level at 10% would be a buy at $64, at 20% at $56.54, and at 25% you are still getting a very nice MOS level. But again, bear in mind the cyclicality of this company, not at the 30% level just yet today. So in terms of the conclusion, 32% upside from Wall Street with a 25% at a minimum margin of safety based on the estimates and judgments. As always though, do let us know your thoughts in the comments below. Are you adding to any of these? Maybe they're on your watch list, or for whatever reason, some of these just aren't suitable for your portfolio. If you enjoyed the episode, value was provided, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.